Thanks so much for tuning in to today's Talking Point. I'm your host, Neeraj Shah. Our guest today is Manishi Raychaudhuri. Needs no introduction. Joins us from Hong Kong. Manishi, good afternoon to you. Thanks for taking the time out.
Thank you. Thank you, Neeraj. It's a pleasure to be here.
Likewise. Manishi, I will invoke some of the conversations that we did the last time and ask you for feedback on or updates on those views then. But before we get to that, just a quick perspective on what is your view on the common or seemingly common narrative now that the broader markets look very overextended in India, and it might be time to be a bit cautious.
Right. So, there are various different ways of looking at that question. I will start with the most obvious one, which is valuations. If you look at price earnings or price to book multiples, the Indian market, measured by MSCI India or Nifty, is at about 20 times 1 year forward on price to earnings, which on the surface might appear expensive. But when you look at it in the context of forecast earnings growth, like for a Nifty or both for MSCI India, we have about 18 to 20% CAGR, compounded annual growth rate, over the next 2 years. And after a period of earnings estimates declining, it seems to have stabilized. So these earnings growth estimates seem credible for the time being. So, in that context, when juxtaposed against future earnings growth, the absolute valuation does not really appear too expensive. It's in some kind of a no man's land. What does appear expensive is actually relative valuations. When you look at India in relation to her peers in the Asia ex Japan region, then the relative valuation does appear expensive, but that's more due to a very sharp underperformance by the North Asian markets and particularly China. So I think for the relative valuations to correct themselves, the North Asian markets, particularly Hong Kong, China, would have to recover. And then things would appear a bit more stable in the eyes of the foreign investors.
Hmm. Okay. Could some technical factors come to the fore to bring about a corrective move in this market, which relatively, as you said, might in certain pockets, select pockets, look expensive? Let's say oil at 94, 95, and if it continues its march higher than that, or a Fed which potentially signals to be a bit more hawkish than what the street estimates right now, or some such.
See, some of these factors that you talked about, they can impact the entire gamut of emerging market equities. You know, Oil, of course, has a slightly higher degree of significance for India than for many other markets. And it's been hovering around 94, 95 for the past few days. If it moves higher, goes beyond 100, yes, definitely it would have an impact on the Indian currency and therefore on foreign flows as well. That is something we have to watch out for. Um, but apart from that combination of oil price and therefore the consequent impact on currencies, there's hardly anything else which would have a disproportionately higher impact on India. The any possible Fed surprise or any other global central bank's surprise would certainly affect flows into the entire region. But in this context, I would think India could be relatively protected because of the huge quantum of domestic flows that India is seeing. And in fact, India is in a sense in a unique sweet spot in that respect. No, almost no other market in the emerging market universe has that level of domestic participation in equity, and that seems to be only going up.
Hmm. Hmm. Okay, Manishi, there is over the last 24 to 36 hours, what has also caught the eye of everybody is the to and fro between India and one more nation. Now, I'm not trying to get into the specifics of this particular event, but just trying to understand if indeed diplomatic relations between two large countries are of the nature that they seem to be currently between India and Canada. I'm just trying to understand, not with regards to specifically Canadian funds necessarily, but could could pension funds or other funds of a particular nation, uh, could the investments of those come under, some bit of withdrawal if indeed relationships are like this? Are there past instances? Have you had a chance to think about this at all?
Right. So let me point out that yes, I mean, some of the pension funds and other long dated investments from that part of the world, the Western Hemisphere, their participation is no doubt significant in the Indian market. But having said this, India has also been in a relative sweet spot geopolitically over the past maybe 1 year or a little more than that. And we don't really expect that situation to change very drastically. Um, Ultimately, investors, both foreign direct investors and portfolio investors, are interested in the fundamentals of the market, in the growth prospects, and the government policies which are affecting the domestic economy. If this particular environment does not change significantly, we don't think either the foreign direct investment picture or the foreign portfolio investment picture would change significantly either.
Okay. Now, and therefore, Manishi, the last time that we spoke to you, you had mentioned that while the valuations are expensive by and large in India, just the breadth of quality stocks available means that the premiums would sustain because money will find enough options to get deployed into. Now, I wonder when we spoke last, the indices were maybe about 1,000 odd points lower than where we are right now. We're now currently at all-time highs, and the broader markets have only extended super streak. So I know you. I asked this question to you at the beginning. I'm just trying to understand because the valuations are so high. You still believe that these premiums could sustain because of that breadth of quality available?
Investing in Indian equities right now has to be focused on stock selection. Particularly, one has to look at those sectors, those stocks, which have a degree of earnings resilience, where the earnings estimates are stable and are likely to go up going forward, and which obviously have the domestic economic and policy tailwinds to enable that kind of earnings resilience. So that is really what we look for. And if one is able to identify that set of sectors and stocks, then even in the event of a broader market correction, be it an absolute correction or a time correction, that investors' outperformance of the market would be ensured. So I think those are really the factors to look at right now in a market where the broader or the headline valuations don't really inspire too much of confidence.
Got it. Could it be that the headline numbers now, despite the fact that the large caps are not expensive, that they may stay quiet? Banks are not necessarily finding a trigger. If indeed, whenever there is a rally, the narrative of peak net interest margins comes to the fore. IT kind of stuck between a rock and a hard place. Maybe the future is positive, but one doesn't know how far out that is before the tide turns. So that's about 45% of the index stuck, if you will. And therefore, does it mean that large caps continue to stay weak? And part two of my question is, do for either of these two indices or some other laggard industries, are you constructive and would you advocate starting to invest into these?
Right. So you, of course, asked me quite a few questions in the garb of one, but let me take them one by one. So first, as you said that, the market could remain pretty much where it is. Yes, we do agree to that point of view, not only in the context of India, but in the context of entire Asian or emerging market equities. In a sense, today's scenario actually reminds us of the period that we went through during the 2000 to 2003 time horizon. First, we had a very sharp bear market for almost 20 months. That was, you would remember, the bursting of the dot-com bubble in the early 2000s. markets initially bottomed out, then we had a small rally, but then again there was a 1 year period of drift, a very tired sideways movement from mid 2002 to mid 2003. In a sense, we are almost in that kind of a situation now. We have had a pretty sharp bear market from early 2021 to late 22, which is again, about a 20 to 22-month period. We have had a bit of a run up in the early part of 23, but we're again settling down to a very narrow, and a very tired sideways drift. So, and even the macroeconomic questions, macroeconomic considerations that we face in terms of rate trajectory, in terms of earnings growth, they are in a very indecisive kind of period, which is not really the right time and place for investors to make a big decision on. So I think, yes, this period would continue at least till, the first or second quarter of 2024. What should one do in this context? Fortunately, India is still a growth market. Both economic growth and corporate earnings growth are decent. And if one is able to find out, a relatively, attractively valued set of stocks in the attractive sectors, then such an investor would have hit a jackpot. It's not an easy ask at this point of time, but one way of trying to do it is to figure out which are the sectors that are likely to have earnings estimate increases. Because in those sectors, what's appearing expensive today might appear cheap tomorrow if the earnings estimate itself goes up. Some of these sectors are possibly financials. One has to be selective, and we prefer the private sector financials here because they are the ones who are gaining market share. Another such sector is industrials, where there's increased order flow in railways, in defense, and various other pockets of government-sponsored infrastructure, which would have an impact on private capex as well, maybe with a time lag. So those are, the kind of pockets with earnings resilience that we are focused on.
Got it. Well, the largest private bank, unfortunately, post its analyst meet today, is seeing a bit of a corrective move. But I think what Manishi Raychaudhuri is talking about is parked out, not necessarily in the next 2-3 months, but over a period of time. Manishi, that if that theory plays out, then it kind of works beautifully with the timing around the elections as well, right? Because by that 1 year period, elections are behind us as well, which actually removes one big uncertainty.
Absolutely. So that is, one variable that investors are very keenly looking at. We do face questions from overseas investors constantly on this. Now, fortunately, it seems the kind of political and policy continuity that we have gotten used to over the past decade, that seems likely to continue. So, it's not a major concern at this point of time, but it's a bridge that we will have to cross when we come to it.
Got it. My final question, Manishi, and that is on, where. So you of course talk to large investors. Your client pool is not necessarily the one which looks at SMIDs very closely, but because the small and mid cap and small cap indices and the stocks are the ones which have done the best, really, if you will, in the last 3-4 months of the rally. Where within the small cap pockets are you constructive? Because while you would have a bent towards large caps, but there are certain industries and certain sectors which don't necessarily have very large caps. They have, by definition, small and mid cap names. Where is it that you are most constructive on within that bucket?
Now, this is a bit tricky right now, especially because the small and mid caps have rallied about 30 to 40% in the last 3 months. And their valuations are really looking stretched. In fact, we talked about valuations earlier. I think the broader market on absolute terms in relation to forecast earnings growth is not really looking that expensive, but the small and mid cap indices possibly are. So that is a universe where we think investors would have to be very selective right now. They would have to look for companies that have strong growth prospects, and even within them, they will have to look at buying them at the right price. So, unfortunately, it's kind of a long winded reply to your question, but there's no easy answer.
Which is why I was trying to get a sense from you on that, but I agree that there aren't any easy answers per se. But just trying before I let you go, Manishi, are there pockets you may not necessarily be buyer in them right now, but are there pockets that you would keep in your mind if a corrective move were to happen, which are necessarily non-large cap?
We would definitely look at some of the consumer discretionary, the white goods, that segment, where, in addition to a couple of large cap, you have a long tail of small and mid caps. I would also keep an eye on industrials, construction, that particular sector, where, as a consequence of the order inflows coming in favor of the large companies today, the benefit might flow down to the mid caps and small caps tomorrow. So those are the two sectors that come to my mind, almost immediately.
Fair call. Manishi, lovely talking to you as always. Thank you so much for giving us these insights, and have a great festive season, even in Hong Kong, but have a great festive season from an Indian perspective.
Thank you. Thank you very much.
Pleasure was ours. Viewers, thanks for tuning into this edition of The Talking Point.